Then we switch to a kind of a different topic, but it relates, and it's called real option analysis. Well, originally, the discounted cash flow techniques were developed to value securities such as stocks and bonds, which are pretty much passive investments. Once the investment has been made, most investors can take no actions that influence the cash flows that they produce. However, what we're talking about here are capital budgeting projects, and they are not passive investments. Managers can often take positive actions after the investment has been made that alter the project's cash flows. Opportunities for these such actions are called real options. The term real distinguishes them from financial options like stock options, and the term options means they offer the right but not the obligation to take the future action to increase cash flows. Real options are valuable, but this value is not captured by conventional net present value analysis. In real option analysis, a project's real options are considered separately. Here are some types of real options, projects that have embedded real options. So the abandonment project is one that can be shut down if its cash flows are low. Investment timing is a project that could be delayed until more information about demand and or like costs can be obtained. An expansion project is a project can be expanded if demand turns out to be stronger than expected. Output flexibility means that a project's output can be changed if market conditions change. And input flexibility means that inputs used in a project's production process can be changed if input prices and or availability change. So here let's just look at an example of an abandonment option. So we've got a cost of $200,000 at time zero and a project that's supposed to produce cash flows of $80,000 for 3 years. And they said the weighted average cost of capital is 10%, and then they computed the NPV, and they got a negative NPV. And so this looks like a project that we would reject because it's taking away value from shareholders. So for this one, more information about it, the project's cash flows are depending a lot upon customer acceptance of the product. So they've come up with the fact that there's a 60% probability that the product will be successful and have cash flows of 150,000 rather than 80,000, but then there's a 40% chance that it would produce annual cash flows of negative 25,000. So here's what the timeline would look like for those two options. 60% chance that it's really successful versus 40% chance that it's losing value every year. And it still costs $200,000 at time zero. So the first NPV based on the good scenario is $170,000. And the second NPV is a negative $262,000. This is assuming that this is going out over 3 years and that you continue to lose money and you continue to stay in the project with this 40% probability even if it goes badly. And so what you get for the overall expected NPV, if I multiply the 60% chance times the first NPV plus the 40% chance times the second negative NPV, I get an expected NPV of negative $1,051, which would still say I should reject the project. However, the thing that we didn't consider is that after year one, if we know more information that this project is a failure, we would stop the project. So with the abandonment option, the company doesn't have the option to delay the project. So you have to start it and you have to see what happens. Now after 1 year, you can abandon the project. So that's the whole idea with this type of project. And then after it's abandoned, then you don't have any of those cash flows anymore. So this is what this would look like. So now we have this, if it's successful, obviously you keep going with the project and get the hope for the positive NPV. But if it's not successful, then after year 1, you just abandon the project. And so now we calculate the expected net present value considering the abandonment option, and we get a positive $14,725. So this would mean that we should accept the project, just knowing that there is a 40% risk that we could have a negative $222,000 in terms of taking away shareholder value. And then a final question should be, should an abandonment option affect a project's weighted average cost of capital? And since the abandonment option reduces risk, because we have the option just to leave it and stop doing it, it should reduce the weighted average cost of capital for the project. And that was the end for Chapter 12, and we just kind of focused a little bit at the end on the abandonment option.